For our investors who are new to giving allocation to an asset manager who's into global quant trading, would you help us understand what does a global quantitative trading fund do, and why does it have to be global in nature? What is the importance of being, having global exposure, and also peculiarities where we could point out how is it different from a conventional long only asset manager? If you could elaborate on this.
Sure. See, maybe I'll try to piece this into different components and try to answer it.
Sure.
Let me go back to the core part of it, right? What exactly is quant trading, right? See, in quant trading, what we try to do is to basically try to find recurring patterns in the market. And to do that, right, you need to build technologies who can process petabytes of data. So, give you an example, petabyte means 1000 terabyte. 1 terabyte means 1000 gigabytes, right? So, that kind of size of data at which we try to build our machine to do research, to find pattern in the market. So, it's crazy amount of data. You're building technology where you can process that data and find some pattern in the market, which you believe have high probability to occur again in the market in the future. So once you build this kind of technology, right, it needs crazy amount of investment, crazy amount of efforts to build this kind of technology. So one of the best way to leverage whatever you're building is to make sure that you use the technology for multiple markets. So for us as a quant trading firm, the return from that capability building or return from the investment that we do to build this kind of capability can never come from single market. So that's why most of us have to be global, because the amount of money invested in this infrastructure is huge. To give you an example, right? Obviously, we are a very small firm now. We just started our roots in 2-3 years back. But some of the biggest firms, give you an example, they spend $500 million every year in their technology. I'm talking about trading firms. I'm not talking about technology firms. I'm talking about trading firms spending $500 million in a year on their technology. So that kind of investment goes behind building good quality quant engines. But when you're doing that kind of investment, right, you need to make sure that it's scalable, it's repeatable, it can be used with multiple markets. So that's why for us to recoup our investment back on the technology, we try to be trading multiple markets. So that's the core reason that a lot of quant firms prefer doing multiple markets. That's one part of the thing. Secondly, see what we believe, right? The opportunity, market moves in cycles, right? We all know, right? Currently we are in a very crazy cycle in bullions, right? So let me say, give you an example. 1 year back, everybody was talking about Bitcoin is new gold, Bitcoin is new gold, Bitcoin is new gold. And actually it happened, right? Bitcoin become new gold. It's not moving at all. It's flat for a year. What gold used to do for, let's say, 8 years before that, right? And then gold has become Bitcoin. So they replace that. So market moves in cycle, right? You never know what will happen in which market will happen. Nobody will have predicted that. What happened in gold and silver will have happened in gold and silver a year back, right? Nobody will have predicted like Indian market will underperform US market for almost 3 years now. Nobody will have predicted that, right? But it happened, right? These are things happen. Market moves in cycles, right? And it's some of the most difficult thing to do is predict these cycles. So what we try to do is build machine which we can run on multiple markets. And if any market is going in certain cycle, if any market where the activity is more, we try to make money more from that market. And maybe there's activity is less, we are underdeployed in those markets. So this gives us capability. Since we anyways investing so much into technology to trade these markets, to process data of these markets, to make money out of these markets. So this gives us an opportunity to play these different cycles, right? You don't have to be dependent on one market or one particular set of stocks or particular set of instruments to make money, right? So that's how it works for us. It helps in us allocating risk better. It helps in capturing opportunities better. It helps in getting recoup on our investment. And you asked me like how to differentiate between traditional, right? See, what I'll say that, see, traditional investment is what, right? So I love Warren Buffett, right? What is this? When you invest in a company, you're actually buying that company, right? You're buying a company. Whether you buy 10% of that company or buy 20% of the company, but it's about buying a company, right? And when you buy a company, right, you buy a lot of things. You bought a house, you buy fruits, you buy groceries, right? Do you buy grocery at any random rate, or you buy them at an appropriate rate? Okay, this is the benchmark price. This is supposed to be the fair price. So, in our thesis, tradition, like I'm just quoting some of the biggest expert on this topic, like Warren Buffett, right? What you buy is very important, but at what price you buy is very, very important. And we believe, right? So if you are investing in any particular market, right, irrespective of what happened in that country, or irrespective of who is the prime minister, or irrespective of whatever happened in that country, right? If you buy something good at a good price, it will give you return. There's no doubt about it. But if you buy something good at a bad price, it will not give you return. So investment need to be done from that mindset. It is not like you have to buy every day, or you think if you keep buying, you'll keep making money. To give you an example, Warren Buffett, Berkshire Hathaway is sitting on $350 billion of cash reserve. Why is he sitting on 350 million cash reserve? Because he believes that there's not right price. He doesn't believe they're not right companies. He said there's not right price. And if history teaches us anything, right price too comes in the market. So I think investing of late, what has become is chasing things. It's not chasing. It's just simple. Buy a right company at right price. And I think the right price part is being hidden in the market for some time now. And that's the reason last 18 months have been tougher for a lot of people, because right price is as much important as right security or right instrument. And that's where we believe an alternate is such a good part of anyone's portfolio, right? Because we try to play different cycles in different environment, different securities, different exchanges, right? We provide you that diversity. Plus, the way we function, right, or is more like an absolute mandate, right? So what we try to do is to find that smaller opportunities available in the market. We're not looking for one crazy long-term bet. Okay, I'm buying a company. I'm not buying a company. I'm finding a pattern and trading that pattern, making a small alpha, moving on, finding the next pattern, moving on, finding the next pattern. And there are days, smaller firms like us do more than 10,000 trades patterns in a day. And some of the bigger firms in the industry, they do what? 10 million to 20 million trades in a day. Wow. Right? So us is finding those smaller patterns. They are not looking for the right price, right stock. We are looking for smaller patterns. And that's where machine helps in doing that. It cannot do that as a manual guy. You can do it only through machines.
Okay. So I guess for our end clients / investors, the key difference, as Ajay explained, is about finding recurring patterns, going global, so that wherever these opportunities come, you could allocate more capital to that geography or to that asset class or to those set of instruments, and eventually ending up creating a machinery that the mandate for which, the asset manager's mandate for which, is to generate absolute return in shorter time frames of, let's say, 1 year, versus the mandate for long only asset managers, where the mandate is to beat the benchmark and generate returns over a period of time by owning good companies at the right, buying them at the right price and owning them for a longer duration.